Welcome back, ladies and gentlemen. We are getting to the final sessions of the day. I would like to now introduce our guest address. Marcello Minenna is Head of Unit, Quantitative Analysis and Financial Innovation at the Italian regulator Consob. He is a contract professor of financial mathematics at Bocconi University, and he's here to talk to us about the technical implementation of the probability scenarios in Europe. Thank you, Marcello.
I thank you, the organizer, for having invited me today. And obviously the opinion are strictly personal and does not involve neither Consob nor the Bocconi. And let me introduce the topic of today that comes actually from some pieces of researches that I have done in the last decade, I would say. In year 2011, I wrote an opinion piece on Risk magazine where actually I make some forecast about what could have been the possible future for the regulation for structured products. And I anticipated that there could be a possible prohibitionist approach. And actually, in these last 2 years, we have seen several interventions in this direction. At that time, I actually recalled some pieces of research of Akerlof in this piece. Akerlof 45, 50 years ago, you know, with the famous lemons theory, displayed, some important concepts. In a certain sense, Akerlof was just saying that as long as you make clear the issues of what you are selling, you put yourself and your counterpart in a safe position. And when we speak about structured products, the point becomes, what are the issues? The issues are the risks embedded in the financial engineering that is besides the products. And in this research, that actually became also a book published by Risk a couple of years later, I thought that it's important to use probability theory in order to offer those pieces of information that a retail investor can crunch and in this way can grasp the risk of the products he's going to buy. In other words, take an informed decision. Let me bring you through the main intuitions that are besides this framework, this quantitative framework, and in order to do this, you will see that I will just recall some pieces of probability theory and quantitative finance that has been developed over the last 30 years, more or less. So there is nothing new, but everything has been rearranged, as in physics we used to do, actually. Let's take an index-linked certificate. You know that an index-linked certificate is the result of a complex financial engineering process. It embeds several derivative components. In this example, we can say that this is exposed by interest rate risk, market risk, and also secondarily to the counterparty risk. Well, the fundamental theorem of asset pricing taught us that if we want to understand something about this product, in other words, if we want to compute the fair value, we have just to forecast what this product will do. Then we have to build the probability distribution at the expiry date or at a certain date of this product, at a certain time horizon. Then we have to discount and average, and in this way we get the fair value. So what we know? We know that we have two main pieces of information that comes from the same framework. The average, the fair value, and what is besides this average, that is the probability distribution of the product. That in fact is called also the implied probability distribution. So that is an important cornerstone of the risk information that we have to analyze, and we have also to transmit, we have also to communicate in a frankly let's say, and clear way towards our investors. The first thing that we can do in order to increase the level of information that is besides these two pieces that I have just explained is the unbundling of the fair value. And again, we take another piece of quantitative finance theory. In other words, we take the replicating portfolio decomposition technique, and we decompose the fair value within the risky component and the risk-free component. The risky components is just the zero swap, where the two parts of the swap represents exactly all the risk components that cannot be embedded in just what is the risk-free floater part. In other words, the cash account compounded over time. This piece of information is important, gives you a first gut feeling about the product riskiness, but it's still the opening of an averaged information, because we are decomposing the fair value. So we are not working directly on the sigma algebra, the entire sigma algebra that is beside this fair value, in other words, the probability distribution. This table is a first step anyway, because you know that you pay 100, we have 3.9 of cost, and then you have 86.2 that is the risk-free component, and 9.9 of the risky component. Look, this is not the bond and the derivative component, because those unbundling is an old-fashioned unbundling, because it does not take into consideration counterparty and credit risk, because the bond component actually has credit risk inside. So it's something that we could accept maybe 15 years ago, 10 years ago, but definitely after the world has changed, because we realize that credit and market risk work together and define the full picture of the riskiness of the product, definitely we have to move towards a different unbundling in order to explain a little bit better what is besides the fair value of a product. But as I mentioned before, the full representation of the riskiness of the product is the probability distribution. And the probability distribution can be analyzed in several ways. We can use all the statistics of this distribution. We realize that, for example, this distribution is plurimodal, there is a lot of skewness, kurtosis, we analyze all the moment generated, whatever. Or we can just take a proper partitioning of this distribution in order to create a probability scenarios where you have just like three events. The outcome is negative, is neutral, and positive. And by taking this proper partition, we can, for example, realize that this product generates negative outcomes with a probability of 18.9% and with an average result of 49.1 euro or dollar. So in other words, you invest 100 and at the expiry date you have 18.9% probability of receiving back 49.1. This is not the full picture, because there is also the neutral scenario where you have 68.9% probability of investing 100 receiving 120.9. Or you have another scenario where the product is satisfactory because you invest 100 and with 12.2% probability you receive back 131.6. Let me say that this piece of information is something that is definitely relevant because it opens the risk. Don't tell me that you can understand what is going on just with the fair value, because otherwise I will put you in the corner, because I created three products that has the same fair value, but they are completely different. And how can you choose? Just by following the name of the product, index linked certificate, auto-callable defaultable bond, VPPI product. Maybe the second one is more risky because it has more letters in the name. Is not that the case. So we have to go through the probability distribution also in this case. And by opening this piece of information, we realize a completely different picture. Yes, the product has the same price. The average of its implied distribution, probability distribution, is the same, but the riskiness of these three products are completely different. And for example, we realize that the auto-callable defaultable bond never works in the satisfactory scenario, because all the probability mass is between the negative and the neutral scenario. And for example, we can realize that the first one, in terms of result of the satisfactory scenario and the negative scenario, neutral scenario, just by looking at these figures, is definitely more efficient than the first one. Let me clear away the field about the fact that the probability is something that you can understand, that everybody can understand. Otherwise, in the movies, in the screenplay of the movies produced by Hollywood, we would have never found so many times this piece of information in order to pass to the general public this kind of information about the risk of some events. And also, since in this moment our Prime Minister comes from Tuscany, I cannot avoid to make a citation of our sommo poeta Dante Alighieri with the Divine Comedy. Also there, in the Purgatory, there was a reference to the probability, even if Dante Alighieri was not an expert like Kolmogorov in probability theory, because Kolmogorov was born later on. So, let me leave the jokes outside from this room, and let's face another technical important aspect. The risk model. I have heard in the long debate about the probability scenario, yes, but this kind of piece of information is model dependent. False. Definitely false. Because when this is actually quite a phenomenon very well known in my field, in the co-finance field, because you know, when you partition a probability distribution just in 3 events, the kind of aggregation of the probability mass tends to neutralize the risk model. In fact, in this case, you see the same very complex product, the index Likens certificate, that in terms of statistical distribution is a plurimodal, a lot of kurtosis, analyzed with 2 classes of models. The first one, I price and I compute the implied probability distribution with the Merton-John diffusion models and the All-White 2-factor model, and also with the variance gamma model and the Cox-Ingersoll-Ross. The models are properly calibrated to the market data. This is the important fact. Obviously, if you use a model not calibrated to the market and not and bad specified, obviously the probability distribution will move a lot. But if your models are properly specified and calibrated to market data, in fact, this kind of probability is called also market implied probability distribution, you will realize that the difference for each box is less than 4%. And 4% in terms of risk percept, 4% probability, is absolutely negligible. In fact, in the negative scenario, just the difference is 0, for example, in this case. In the neutral scenario, is just 3.1% probability, and in the satisfactory scenario is again something very negligible. These in pieces of information, the unbundling and the probability scenario table represents what I call the first pillar of information for structured products, in order to disclose risks about structured products. And it's not a surprise for you that these pieces of information are actually the same ingredients that are used by the industry to compute VAR, expected shortfall, and all the Greeks, all the metrics that you as a representative of the markets use in your activity, your desk, your risk manager, your quants, your the subject that works directly on the desk and within the banks, mutual funds, whatever, investment institution, investment banks, and so on. Actually, this cannot be the full picture. Because in this information, what we have studied what happens at the beginning by unbundling the price that you pay, and what could happen at the expiry date. Actually, we have to give also a full representation of the product over the time horizon. And to give this, why this kind of information is important? Because if we take a look at the volatility of some products over time, and the volatility is definitely a proxy of the risk of any kind of financial products, you realize that the volatility displays definitely different attitude and behavior. For example, this is a fixed bond-like volatility. When you make a simulation of the risk-return profile of the product. Look how much is different for a floating bond like. And look for a zero coupon bond. Very simple products. Look what happens for a structured bond. We have just, in this case, a European option on a share index. So what I'm saying is that the representation of risk over the time horizon of the product or over the time horizon of your investment is definitely different. So we have to find some solution in order to represent this full picture. And something that does not offer a misrepresentation of these pictures, of this different attitude of the financial products according to their financial engineering over this, in terms of risk-return profile, over the time horizon that we are looking for. So, we have to create some volatility intervals. And these volatility intervals cannot be calibrated in a subjective way, or with some rules that does not follow proper criterion. First thing, they have to partition in a proper way the volatility space, all the volatility space, between 0, let's say, and plus infinity. And we have to find an optimal discretization of this volatility space. How to do this? The requirement, the more the riskiness, the more the losses. So we have to calibrate, and in this case we use some Garch diffusive approach in order to calibrate this table, in order to identify some criterion that partition the volatility space in a way that would respect this thumb rule. That is the only thumb rule. The rest is definitely something that could bring you in the wrong direction. If you don't perform this kind of non-linear optimization, stochastic non-linear optimization, obviously you will definitely end in something that is not properly calibrated. They will not represent the full riskiness of the product over the time horizon. It would misrepresent the riskiness. After this calibration, that is the table of the volatility observed on a daily basis. So if your product has not a daily, let's say, representation of price and returns, obviously this table has to be calibrated differently. If you have, for example, a weekly representation of the risk return of the price and return of the product. And when you have this table, it's quite a bread and butter to identify what is the degree of risk of this product. Because you just compute the volatility of the products over the time, and you will realize that, for example, this product has a medium-high risk, because obviously you then transpose these volatility intervals in terms of some labels that can be also more crunchable. Because one thing are the probability information. When you are in front of the doctor, unfortunately, because you have a disease, you ask, with this care, how many probability I have to survive? And definitely you understand if it tells you 10% or 20% and you take your proper decision. But when you have an information about volatility, what does it mean 20% volatility daily computed, annually observed? So in this case it's important to give a qualitative representation. And the qualitative representation are these labels. And with these labels in your pocket, you are in the condition, for example, to understand that a product like this one has a high degree of risk, and this other one has a very high degree of risk. We have, in this way, analyzed what we call the second pillar of the risk representation of a structured product, of a non-equity products. Because remember, we are speaking about non-equity products, because for equity the world is completely different and you cannot proceed in this way at all. Also, this pillar does not complete the full picture that about riskiness of the product, about risks that an investors need in order to take an informed decision. Because there is a big question that we have still to answer. For how many years I have to keep this investment in my portfolio? Because yes, there are some products that you know from the beginning, they are completely illiquid. You cannot do nothing with this product. You have just to buy and wait the expiry date. Okay, In this case, the first two pillars are enough, and the third piece of information is just the lasting of the product. If the product lasts for 6 years, 6 years is your investment time horizon, because the product cannot be traded, sold, or whatever. But we know that, luckily, let's say, a lot of products can be traded, can be traded on the market, can have the possibility of also be sold, maybe also in a bilateral way. In other words, there is a problem to be fixed. For how many years? What is the minimum investment time horizon for this product? And look, you have already in this sentence the answer to your question, again by using some pieces of probability theory. Because in probability we study what is called the first hitting time probability. First hitting time probability is a tool, let's say, that allows you to compute in terms of probability the first time that a certain path reaches a target. And this is exactly the same problem. If we know where the product can go, and we know, because otherwise we cannot compute the fair value, remember these passages, in order to compute the fair value, you have to discount and averaging the possible future payoff of the product. In other words, what we have to do? We have to identify the initial cost. We have to identify the running cost, or the cost that you pay if you exit before the expiry date, these kind of things. And then you have to make projection about the future payoff of this product. And anytime you recover the cost, you can start to compute time when you recover the cost and how many times in that moment you recover the cost. And by making this exercise, as you see in this animated slide, you are able to compute the first hitting time probability density function. That, in other words, tells you in how many years you recover the cost of this product. And so becomes the minimum time for your investment. Obviously, once you have the density, you have to cumulate this density, and so you compute the probability distribution for this first hitting time probability, and then you take the first derivative of this cumulative probability distribution in order to compute exactly when the product will be able to recover the cost. Why you take the first derivative? Because we have to be compliant with another rule, that is another thumb rule in structured finance, but also in finance, that the more the volatility, the higher is the time horizon in order to recover the cost. That is for sure, because the more are the losses that you can incur. This other piece of information would represent what I call the third pillar for the representation of risk of structured products towards investors, but also, in my opinion, in order to complete a full picture in a normal investment decision process. Because actually, anytime I take an investment decision, I make more or less 3 questions. First one, what is my investment time horizon? Because usually I have a liquidity preference. And so the first thing I want to know, okay, I give you my money, but apart from the return, the potential return, for how many years this investment is blocked? And in other words, for how many years this investment will not recover its cost? The second is the risk appetite. And so, in other words, how much risk I want to undertake when I make my investment. And the third one are the potential returns. And so, once I have filtered in a sort of sequential filtering problem the first 2 steps, I enter into the third step. What is very strange is that usually I see that the process is exactly arranged completely the other way around. And the first thing that it is important to illustrate are the potential returns. And what is besides that potential returns, and actually this is part of potential mis-selling and issues, is exactly the fact that your liquidity preference, your risk appetite are not taken into the right consideration. Let me also conclude, and then I will open to answer all your questions, with the fact that this piece of information can be definitely used also for enforcement activity. And also in order to understand concretely what are the conducts that have been acted by intermediaries towards retail investors, and to understand exactly what are the risks that are, in a certain sense, translated to the final investors with a specific conduct or let's say budgeting plan where you know in a bank is defined what kind of products we will sell this year and etc. That's all more or less the full picture of this approach, and I thank you for the attention.
Thank you, Marcello. Can I ask what happens if a product changes its risk profile over time within this quantitative framework?
Yes, that is an important aspect. It is, you know, a bank, when a bank makes for his proprietary trading an investment decision, usually monitor every day what happens. If you think a bank that buys an option or whatever kind of derivative or structured product, they compute every day Greeks, VAR, expected shortfall. They are, for example, also risk limit on the desk, you know, because they have to monitor in order, for example, to implement at least a stop-loss strategy. In this case, it is clear that this piece of information is valid at that time. But this piece of information, since the market moves, also the risk profile of the product changes. Because the kind of attitude of the market, since this product engineers pieces of the markets eventually, obviously can change its risk profile. So also by using the same tools that I have explained here, you can define an updating rule. In other words, a moment in which this kind of information has to be updated and communicated to the investor, in order that the investor put himself in the position that he can decide to continue and to stay in this investment or to make a stop-loss strategy, for example. And it's quite easy to arrange a thumb rule in order to monitor the risk, because, for example, when the probability scenario moves within one box more than 5-6%, so we can identify, for example, 5% probability or 10% probability, you can update this piece of information towards retail investors. And the same for example, the degree of risk. If originally the product has been sold with a degree of risk medium, if it becomes high, so you move 2 notches upward, you know, it is clear that this piece of information has to be, in a certain sense, has to be given. Also because, what does it mean? It means that the market, the change in attitude of the market has an impact in the attitude of the product, because the product replicates some attitude of the market according to the payoff rule that is besides the financial engineering of the product. And so it is important that in terms of suitability, in terms of the investment, the information, the investor is informed about that. And since these pieces of information are quite digestible in a certain sense, is also clear the rule that will define the update of information. And in this way is also reduced, in my opinion, the risk that a bank or an investment institution can receive, you know, a recall or a letter of a request of information from who make the surveillance on this subject, because it's just following the updating of information, something that is, you know, well written and clear, because follows some technical and let's say mathematical rules.
I have a question that relates this topic to the one we had on the marketing a bit earlier, the clear and fair language towards the end client. I'm curious because I think it's a very interesting approach, but how to transfer the message of the results of such a way to calculate to the end investor that typically does not possess that high degree of knowledge in financial markets or financial mathematics, how to change this into plain daily language. Do you have any suggestions on that?
Yes. Maybe we want to collect another question and then I will answer. Is there another question or I just... Okay. I think that, let me go back to the first pillar. And let's see together how to answer to this question. Not with the screenplay of the Hollywood films. The point is this one. Think about, are you hearing me? No, only, okay, don't worry. Think about a final investor in front of the second product. He receives this piece of information. Maybe that also the sales representative of the bank could help him in this way. But in my opinion, it does not need, and I have tested this information with my mother. They used to teach philosophy at the university. So if she understood, I mean, it's not Kant, Hegel, or something like that, or Heraclito. So the point is that you say, look, the outcome is negative with 2.9% probability, so very small. If it happens, in any case, you have invested 100 and you will receive 44. The outcome is neutral, so I give you some words also that could help you, but as in my experience it's better to give figures, and you say 97% probability of receiving 112 instead of 100. That's all, because there is nothing better than this in this product. So, what I know, first, I'm not required to compute compounded interest. Because do you think that it is easier to understand that you are buying a governative bond with an interest rate of 3% per year or 1.5% per semester? In your opinion, it's easier? Please, it's not easier. Because if I tell you that this bond has an interest of 1.3% per trimester, you have to multiply times 4. And in any case, you are wrong because there is not the compounding, first. You don't know what is the kind of accrual rule, 360, 365, and there is another mistake. And then you don't know nothing about the default risk. Because I can sell you a Greek government bond that will give you 10% of interest, then first per year, so I help you without saying per trimester or per semester. So first you have to make 10% per year, it means 10% times 100. So I gain 10 at the end of the year, but you don't know nothing about the default. In this case, you don't have to make any computation. You know that in 4 years, you have given 100 and you will receive 112. That's it. And obviously, when you have these 3 pieces of information in these 3 products on the shelf, you know that the third product will give you 155 after the 4 years. Yes, but a very small probability. And the first product gives you 131 with a probability of 12%. I am sure that if I ask you, is there a product that would be definitely outside of the market in 1 second after this kind of information, this piece of information would be disclosed? Definitely yes, the second one. The second one is like Akerlof told us in the Lemons theory, will be out of the market after 1 second. Because the kind of comparison is immediate. You immediately realize that yes, the outcome is quite always neutral. but there is nothing satisfactory there. So in other words, first, it brings you in the position to receive absolute values. And we are used to work with absolute values. When we go, in Sloane Street, it's full of shops that comes also from the Italian fashion. Okay, when you go in front, when you go inside, I was going before coming here to Salvatore Ferragamo to buy a tie. I'm not asked what is the interest of the tie, okay? I'm not saying, yes, but if I just say, what is the price? And he told me, £60, that's it. I know that £60 comes outside from my pocket and enter in the cash of Salvatore Ferragamo. In this case, I know that I give £100 to my bank and I receive with 97% probability 112. In the case of the tie, I will receive 100% probability the tie that worth £60 of my pocket. As regards the second and the third pillar, the things are definitely more intuitive, because the second pillar has also a qualitative label, from low to very high. So if I tell you that you have a very high risk of disease, you know what I'm talking about. But maybe that your second question would be, but what probability? I was yesterday hearing, and in fact I should have updated the slide, about the war in Syria. And on Sky News they say there is a probability of 70% to reach the target that the French guys has identified, you know, with these bombs, with this bombarding activity. So it's something that is part of our heritage. And also the third pillar is definitely intuitive, because I just say you need 4 years to receive back your money. Obviously, is a probability indicator. The very tough thing that has to be clear is that there is no certainty. And this is the first thing that has to be passed towards investors. You have to understand that if you invest your money, you can lose or you can win. Instead, if you don't move in an approach like this one, in my opinion, the perception that you can have is that there are investments that are without risk and investments that are risky. And this is definitely wrong, because in nature, you know, something that is without risk actually does not really exist. You are welcome. Okay. I thank you again very much for your attention, and I hope you have enjoyed the presentation. Thank you very much.